The U.S. job market keeps on holding up. 139,000 jobs added in May, beating expectations and extending a steady streak despite inflation and policy headwinds. For more, we're bringing in now Jennifer Lee, senior economist and managing director at BMO Capital Markets. Jennifer, it's good to see you. So on that jobs report, Jennifer, I saw some economists today. They read through the report, Jennifer, and they kind of characterized it to their clients as this. They said, to them, more evidence of a labor market that, okay, it's cooling, but not crashing. Is that how you see it?
That's a great way of putting it. And thank you very much, by the way, for having me on. My automatic reaction, the first words that came out of my mouth were, not bad, not bad. I think we're sort of thrown by, what we saw from the ADP with that very low figure. So I think everyone was quite nervous. The market was quite nervous. But again, 139,000, steady jobless rate of 4.2%. Gains throughout different sectors like construction, leisure and hospitality, education and healthcare, for example. So we're seeing still steady gains in various sectors. Other sectors are cutting back, obviously, but overall, not a bad report. I'm going to say that the one thing that I thought was actually the most positive news out of that was the average hourly earnings report of 0.4%, or the increase of 0.4% above expectations, the highest in a few months. And it's good news for the average worker. At least they have a little something, a little extra money in their pocket for when they're ready to spend. Not great news for employers because that means that they're shelling out a little bit more for wages and salaries. But at the same time, I think it's good support for the U.S. consumer, which is, the biggest, underpinning, I guess, for the overall U.S. economy.
What does that number imply, if anything, Jen, for inflation more broadly, right? Does that piece tend to be sort of a leading or lagging indicator for bigger inflation numbers that we know the Fed is watching really closely?
Yeah, so can we sort of debate that around here as well? Typically when you have higher earnings, or wages, it tends to be inflationary. But I think that's under the, the normal assumption that people are going to take their money and start spending like crazy. But I don't think that's happening. We certainly haven't been seeing that organically, I guess is the word that I'm looking for right now. Everyone, as long as you have the money, and I think people, of course, were spending earlier in the year, just in advance of all the feared tariffs, the feared inflation, higher prices for all these goods. There was fear of empty shelves ahead of the holidays, for example, which is just 6 months away. So there's a lot of, again, pulled forward spending. But I don't think in this case it's going to be too inflationary from the consumer's perspective, because I think they're just going to put aside a little bit for a rainy day. We saw that in the April personal spending and income report, where they pushed up the saving rate a little bit. And that's not a bad thing. As long as they're in a position to spend when they want to spend, I think that is the most positive aspect of all of this.
Jennifer, what do you think Jay Powell and the Fed made of this jobs report today?
I feel very sorry for the Fed chair. No matter what, I think he's in a very tough spot. Great news that the U.S. economy is still growing. Great news that the job market is still churning out jobs at a steady-ish, albeit slowing rate. But yet, there's that pressure from the Oval Office to cut. From calling him now too late Powell or something like that. Which, anyway, I think it puts him in a very tough spot. But I think all of the Fed members of the governing council, I believe that they're all on the same page, saying that they are going to be patient. The minutes from that last meeting stated that they're all felt that they were well positioned to wait and to be patient, and that seems to be sort of like the theme that we're seeing playing out. Like the ECB yesterday cut rates 25 basis points, and it sounded a little bit less dovish. With Christine Lagarde saying we are in a good place. Everything that we've done so far with the rates the way they are right now, I think we're in a good place to sort of take whatever is going to be coming toward us.
So, as you look forward, do you think the balance of risks are skewing more negative or positive? And I want to ask specifically through the prism of revisions, because I definitely saw a few of your colleagues, other economists today, saying, they were looking at those revisions, which were pretty negative, and also saying this number that we got today is likely going to be revised lower.
That's interesting. So usually it seems like the trend now has been for backward revisions that were going down.
Right.
So we were sort of expecting that. And again, the number isn't, 139,000. It wasn't anything to write home about. But at the same time, it wasn't a negative. It wasn't as if our businesses were cutting jobs. It's not like 250. I remember at one point a couple of years ago, it was on 500,000. So, we're not at that point yet. So the revisions, yes, they will come. there's also some question about, the quality of the data, whether or not everyone is filling it out properly, enough people are filling it out. So there's still a lot of that, but I think it all depends on all the different job surveys that you're looking out there, not just the non-farm payroll survey, looking at surveys like from the Conference Board, from the ISM, seeing what businesses are saying about hiring, whether or not they're hiring or laying people off or whatever, or attrition. As long as it's all pointing in the same direction, I think we can have a pretty comfortable view of how the labor market is faring.
Jennifer, final question. I did want your take on Trump's budget bill, the big, beautiful bill, Jennifer, as he likes to call it. Obviously, concerns being raised about what that means for debts and deficits. I'm curious how you're thinking through that bill, that legislation, Jennifer, as an economist.
So it's going to be a lot tougher, obviously, to push through the bill as it stands right now through the Senate. And we've got a deadline of July 4th, especially on the heels of the Moody's downgrade. Again, not a shock, but just the timing of it was tough. And you're going to see a lot more pushback, I think, because there's a lot more concern about spending too much, not cutting the deficit enough. So there's going to be something's going to have to be taken off the table. Unfortunately, it might look like it's going to be some of the things that he campaigned on, like such as taxes on overtime, for example, or chips. So something like that. Although he'll probably be fighting tooth and nail for those again, because that's what he campaigned on, and that's what people were voting on. So I think it's going to be a very different picture from what we saw pass through the House, whatever we're going to see pass through the Senate. But foreign investors are going to be watching this, and you're also worried about how bond markets are going to be reacting if you're going to see a big backup at the long end. And that could be problematic for the entire economy because that impacts consumer spending, mortgages, auto loans, and so on and so forth.
Yeah, and we've seen little glimmers of that. We'll see how it plays out. Jennifer, thank you so much. Have a great weekend.
You too.